Okay, good morning. We're going to work on Chapter 7 today. And there is a question in Learning Catalytics, so you want to make sure you get logged in. The session ID, Haley's pasting in the chat room. Just a reminder, a couple reminders. Let's do Saturday, the Chapter 7 homework. If you're in Section 3, which is not the vast majority of you live here, you have a quiz due Saturday as well. We have Exam 2 on Monday, October 13th. If you need more information, you want to refer back to that recording. I'm not going to go through every slide today. I have the one slide. Summary. Our exam is Monday, October 27th through Wednesday, October 29th. You have to finish by 8 p.m. Sections 3, 7, and 8 schedule with ProctorU soon. The earlier you sign up with the ProctorU, the better your selection of time slots. If you have to register at least 72 hours in advance. You have to schedule no later than 4 p.m. on Wednesday. If when you're scheduling, if there's anything unusual or you have any questions or anything, don't hesitate to pick up the phone and call ProctorU. There's a phone number there, and sometimes they can do things over the phone that you can't do when you're scheduling online. So don't hesitate to call them. So that's sections 3, 7, and 8. Okay, again, I'm referring you to the recording on Monday, October 13th. There is a 10-point bonus if you submit your exam by 9 p.m. on Monday, October 27th. You have to submit it by 9 p.m., not start it by 9 p.m., and this is Eastern Standard Time. So if you submit your exam by 9 p.m. on Monday, October 27th, you'll get a 10-point bonus. And see that recording on Monday, October 13th for more details. But it's going to work just like the last one. You complete your exams before 9 p.m., you're good. I will add 10 points Monday night or Tuesday morning sometime. Okay, here's the question that's in Learning Catalytics. We're going to, ABC Company purchased land with an old building that it plans on demolishing so it can construct a new modern building. The cost of demolishing the building will be part of the cost of what? The new building, the old building, land, or land improvements. The session ID is there on the screen. If you're just joining us, get logged into Learning Catalytics quickly because this question will close in about a minute. Session 25, 50, 86, 62. Okay, so ABC Company purchased land with an old building. So it's an old building sitting on the land. They have to demolish the old building so they can put a new building on it. The cost of demolishing that building, the old building, will be part of what? The cost of the new building, the old building, the land, or land improvement. Okay. We have about 10 seconds left on this one. That's me. Okay, the cost of demolishing that building is part of the cost of the land. So it's everything to get the land ready for use. If we were digging a basement, that would be part of the cost of the new building. But everything to get the land ready for use is part of the cost of land. Okay, so to start with, I've got a couple slides that aren't in any PowerPoint notes. When I was reviewing what we did Monday, there were a couple key things I wanted to talk about and emphasize. When we talk about plant assets, we're also talking about another term for it is PP&E, or property, plant, and equipment. But that's the main part of this chapter. That we have depreciation expense on. So the word to go with property, plant, and equipment, or plant assets, is depreciation. We know we're talking about something that has physical substance. We're talking about land, or well, not land with depreciation, but we're talking about a building, we're talking about a car, we're talking about something that has physical substance. So plant assets get depreciation expense. Now, natural resources, which we aren't going to talk a lot about, but natural resources are things like timber, oil wells, salt mines. Those have depletion expense. So the word there is depletion. And then when we talk about intangibles like copyrights, patents, that will have amortization expense. We are not going to dwell on natural resources or intangibles. The accounting for those two things is very similar to the plant assets, but we don't call it depreciation. Instead, we call it depletion if it's a natural resource and amortization if it's an intangible. So that's really what I wanted to take away about the bottom two things. It's just that we have a different term for it. We don't depreciate a natural resource, we deplete it. We do not depreciate an intangible like a patent, we amortize it. So those are what those terms mean. Okay, and a couple equations just to emphasize. Book value, okay? Book value is the original cost minus the accumulated depreciation. Accumulated depreciation is a contra asset, and it's always shown with plant assets on the balance sheet. Accumulated depreciation is not on the income statement, it's the balance sheet contra asset. Okay, so book value is going to be a really important term that we know, the original cost minus accumulated depreciation. Now, accumulated depreciation is that running total of all our depreciation expense today. We're going to see that several times. So this running total of all our depreciation expense to date. Okay, now, so what we're going to do today is we're going to go through the three depreciation methods. So what we left off on Monday, we talked briefly about, in theory, about the three methods: straight line, units of production, double declining balance method. Those three methods we will be using in our example that's coming up here. Okay, if you have the PowerPoint slides, this example is in the PowerPoint slides. If you don't have the PowerPoint slides and you don't quite get everything written down, know that you can go back and grab these on Blackboard if you need them, because there's a lot of writing if you don't have them. Ralph's Pizza bought a used Toyota delivery van on January 2nd, 2014 for $13,000. We're going to use this example to illustrate all three methods. So what's important here? We bought it January 2nd, 2014. We do depreciation by full months, so January 2nd, that's the beginning of the year. We don't have to worry about that it's January 2nd, not January 1st. So this is a full year. They bought it at the beginning of the year. They have a useful life of the van 5 years, And at the end of the useful life, they estimated the van's residual value to be $1,000. Okay, so the takeaways there: original cost $13,000, residual value $1,000, estimated life 5 years. That's what we need from this example. So we're going to do this same example using straight line, units of production, and double declining balance method. So and then we'll be able to compare. It's a 5-year life, so we're going to do it for all 5 years. So we're going to start with the straight line method. If you have the PowerPoint slides, the stuff at the bottom here I've added so you don't have it on your slides. The stuff in the red is addition here. First of all, I wanted to show where I get some of the calculations. Original cost minus the salvage value gives us our depreciable cost. That's how much we can depreciate. We can't depreciate more than that. So in our example here, our original cost was $13,000. The salvage value was $1,000, gives us depreciable cost of $12,000. So $13,000 the original cost given to us, the residual value given to us, so we end up with $12,000 as our depreciable cost. That's the maximum depreciation we can ever take. That's the depreciation. We can never depreciate below the salvage value or residual value. Okay, depreciation expense. When we calculate depreciation expense, we take our depreciable cost, which we just calculated as being $12,000. So we can take $13,000 minus $1,000, but that's our depreciable cost, divide by the estimated life in years. So in this case, we'll get $12,000 divided by 5 years, gives us depreciation expense of $2,400 per year. Okay, so straight line depreciation. Straight line is used by more companies than anything else for their financial statements. So straight line depreciation is the most popular method. It's also the easiest method. It's going to be the same amount every single year unless you have a partial year, which we'll talk about later. But for right now, we don't have to worry about that we purchase in the middle of the year. We purchase this asset at the beginning of the year. So we're going to do this schedule. When they ask for a schedule, they're basically saying, let's figure out how much depreciation we have each year. There's not any magic about our column headings, but we do this. We're going to fill out this schedule. We have 5 years. It has a 5-year life. We're going to have a column for depreciable cost. If you have the PowerPoint slides, there's another column in there. We don't need it. It's fine. It's not wrong. I'm just not going to put it up here. Annual expense, accumulated depreciation, and book value. So we're going to go through that year by year. So the depreciable cost is $12,000. We got that by taking our original cost of $13,000 less our residual value of $1,000. So that's $12,000. I'm not going to do it here, but the depreciable cost is not going to change. You can write $12,000 all the way down for all 5 years. That will be the same. Okay. Now, annual expense, that's annual depreciation expense, that will be the same for each full year. So it's $2,400. I calculated it below. I got the $2,400, so I'm going to take $2,400 of depreciation expense this year. I could also take that same amount all the way down every year. Now, accumulated depreciation. Accumulated depreciation is the balance sheet account. This is a contra asset. So this is a running total of all our depreciation expense to date on this asset. So in the first year, it's $2,400. It's going to be the same as our depreciation expense because we don't have any depreciation current before this year, the first year. So my book value, the book value is always the original cost less the accumulated depreciation. So my original cost was $13,000. I'm going to subtract my $2,400 accumulated depreciation, and I'm going to get $10,600 as my book value at the end of the year. So that is our first year. We're going to walk through every year after that too. So year 2, 2015, my depreciable cost doesn't change. It's always going to be $12,000. My straight line depreciation is going to be the same for every full year. We have a full year $2,400, so those haven't changed. Accumulated depreciation is all my depreciation expense to date. So I'm going to take last period's accumulated depreciation of $2,400, add this period's annual depreciation expense of $2,400, and get $4,800. So it's a running total of my annual depreciation expense. And then my book value is going to be my original cost of $13,000, subtract that $4,800 accumulated depreciation, and I get $8,200. Okay, now for 2016, our depreciable cost is the same. That's not changing. Under straight line, my depreciation will be the same for every full year, $2,400. Now, my accumulated depreciation is now $4,800 plus the $2,400 this year, or $7,200. So it's a running total of all my depreciation to date. So I could add my $2,400 for 2014 plus my $2,400 for 2015 plus my $2,400 for 2016. So I get $7,200. And then my book value at the end of the year is my original cost of $13,000 less the accumulated depreciation of $5,800. Accumulated depreciation is always going to be your prior accumulated depreciation plus this year's annual depreciation expense. Well, you can, I guess I was doing that. I was taking last year's accumulated depreciation plus this year's depreciation expense. It's hard to see the different numbers since it's $2,400 each year. Yeah. So in my book value, again, it's my original cost of $13,000 less the $7,200 accumulated depreciation. Okay, now I'm gonna fill in the numbers for these other ones, and I'm gonna talk about. I'll leave those. So if you want to write that down, I have a couple things to say about the last year. But basically, depreciable cost is the same all the way down. Annual expense is the same all the way down. Each accumulated depreciation is the last period's accumulated depreciation plus this year's annual expense. And then book value is always the original cost less the accumulated depreciation. I'm going to go quiet for a minute or two, and then I'll talk about that last line. Okay, in the last year, you see our book value is equal to our residual value. At the end of the life of an asset, its book value will be equal to its residual value. You can have a residual value of 0, but you never depreciate below the residual value. So in this case, we were told that our asset would have a residual value of $1,000 at the end of the life. We never go below book value of $1,000. We will always end up at the end of the life at that residual value, because then in theory we would sell it and get the $1,000. Now, as an aside, if I sell this asset and don't get $1,000, either I get more or less, that's a gain or loss. So when you get rid of this, we understand that those are estimates and you'll probably be off because you had to predict 5 years ago what this would be worth, and that's fine. There's a gain or loss on the sale. That is beyond the scope of our class. If you're an accounting major, you're going to get a lot more of that of what happens when you sell one of these things midway through or at the end. but that's beyond our scope at this point. Okay, so this was the straight line method, and it's the easy method. It's the method used for financial statements more than any other method, because companies look at it and go, this makes sense. Why don't we just take the cost, spread it out over all the years, and be done with it? Now, it is perfectly legal, and it's actually a good idea. You are allowed to use one method for your financial statements and then one method when you fill out your tax returns. This is not two sets of books, okay? When we talk about accounting rules that say you can use straight line, you can use units of production, you can use double declining balance, we're saying you can use those rules. You disclose what method you're using, and those rules have been designed to provide useful information to investors. And you're upfront and you're saying, I'm using this method. You can use more than one method. You can say, all my cars I'm going to depreciate using units of production, and all my buildings I'm going to use straight line or something like that. That is perfectly legitimate. You disclose it in your financial statement. Now, when you go to fill out your tax return is not a financial statement. Your tax return is a way for you to pay taxes for your company, to pay the government taxes. The tax code is written by the government to collect revenues, not to provide financial statement information. So the government has said, here's these methods that you can use on your tax returns. So a company can use a different method on its tax returns than it uses on its financial statements, and that is legal, and it's actually desirable. We'll talk about why you might do that. So I wanted to veer off about why we go through these methods, because there's a reason to use different methods for different purposes. But straight line is used by a lot of companies for their financial statements because it's easy, and we spread out the costs, and it seems easy to understand. It's intuitive. So then what we do is we move on, same example, but the only thing we're changing here is instead of using straight line method, we're going to use units of production. Units of production, here we have a delivery van and our life is miles driven. So we have 100,000 miles driven as our estimated life. So the problem tells us 100,000 miles and then tells us how many miles per year, 15,000 the first year, 30,000 the second, etc. So we're given that information. So we're given the number of miles per year, we're given 100,000 as our total life, and then we are going to be calculating the depreciation per year. So same example, we bought it for $13,000, residual value $1,000. So we're going to go on. So the depreciation per unit of output. Okay, so we're using the production method. Basically, depreciation per mile is what we're doing. We take our original cost minus the residual value, and we're going to divide that by our total life and production units, whatever this is. This could be hours, it could be miles, it could be number of copies, anything like that. Haley, it's $13,000 is your original cost. Yeah. Okay. Okay. So what we're doing with depreciation under the units of production method is we're taking our depreciation, the whole amount that we're going to depreciate, and allocating it based on how much we use the asset. So we say our van has 100,000 miles in it. Let's depreciate it per mile. So when we drive 10 miles, we have so much depreciation. So that makes intuitive sense. If you have an asset that has something that you can measure its usage with, like miles or hours. Okay, so going on to our depreciation schedule. So we need to first calculate our depreciation per unit of output. This is our depreciation per mile. Our van cost $13,000 was its original cost. Our residual value was $1,000 divided by the 100,000 life, the 100,000 miles of life, gives us a depreciation rate of 12 cents per mile. Okay, so that makes sense. We can say, okay, well, we'll just record 12 cents for every mile we drive, 12 cents of depreciation expense. And it told us in the example, gave us so many miles. Okay, so first year, we have 15,000 miles driven. Those miles were given in the example, so 15,000, 30,000, 20,000, etc. So now we're going to multiply our first year 15,000 miles times 12 cents gives us annual expense of $1,800. That's our annual depreciation expense. So now our accumulated depreciation is going to be our prior accumulated depreciation plus this period's annual depreciation expense, so $1,800, because at the beginning you don't have any to start with. And our book value is going to be the $13,000 cost, original cost, minus the accumulated depreciation. Book value is always the original cost less accumulated depreciation. So we get $11,200. So now for year 2, we're going to take 30,000 miles driven times 12 cents per mile gives us $3,600 of annual expense. Okay, now my accumulated depreciation is always last period's accumulated depreciation plus this period's annual depreciation expense. So $1,800 plus $3,600 gives me $5,400 of accumulated depreciation. And then my book value is going to be my original cost of $13,000 minus $5,400 gives me $7,600. And then I'm going to do each year like that. I'm going to do 20,000 miles in year 3 times 12 cents gives me $2,400. Accumulated depreciation is going to be $5,400, my prior year accumulated depreciation balance, plus $2,400 annual expense gives me $7,800. My book value is going to be my $13,000 original cost less the accumulated depreciation of $7,800. $5,200, and then I'm going to fill in those last 2 years. And then I'm going to pause for a minute, and then I want to say something about 2018. For that last year, notice that our ending book value at the end of the life of the van is $1,000. It's residual value. We never depreciate below the residual value of an asset. So this is the depreciation schedule for units of production. So we've done straight line, we've done units of production. Both of those are pretty straightforward. The double declining balance method is the one that kind of makes you think a little bit more. It's not as intuitive, but it's still not bad. So we're going to do the double declining balance method next. Same set of facts, but now we're doing double declining balance method. Double declining balance method is known as an accelerated method. Okay, accelerated method. So we have the same exact facts. We bought the van for $13,000, residual value of $1,000, 5-year life. We're doing the double declining balance method. Okay. Double declining balance rate will always be 2 divided by the years, basically in a nutshell. Okay, very important. The biggest question I get on this is where did the 2 come from? The method is the double declining balance method. What it is, it's actually double the straight line rate. So the 2 is always built in. The 2 will always be there. It's a double rate. You can actually have a 1.5 times balance, and you would put a 1.5 there. But we're always doing the double declining balance method. It's twice the straight line rate, so the 2 is always there. It's not something that's going to change. It will always be a 2 divided by the life. Okay, so there's no magic to it. It's just 2. It's twice as many as the straight line, basically. So 2 divided by the life. So here we're going to go with our double declining balance. So our rate here, our double declining balance rate, is 2 divided by 5-year estimated life. So the 2 comes from the double declining balance method. It will always be a 2. We have a double declining balance rate method. Always going to take 2 divided by the number of years. So 2 divided by 5 years is 40%. That is our double declining, that's our declining balance factor. It's the rate that we're using, and you'll see it in play here. Now, the double declining balance method is the only method that doesn't use residual value in the initial calculations. So you're not going to see residual value subtracted anywhere until at the very end. I'll show you where it goes. So it's different from the others. It's also an accelerated method that lets you take a lot more depreciation in the early years of an asset's life. And the thinking is, well, an asset is used a lot more in the beginning and it wears out a lot more, so we'll have this depreciation that method that kind of simulates that. So an accelerated method, that's a double declining balance method. So we have our 40%. So our beginning book value is going to be $13,000, right? Because book value is the original cost less your accumulated depreciation. At the beginning you have no depreciation. So our beginning book value is $13,000 times the 40% double declining balance rate. So it's going to be times 40%, and that gives us annual expense of $5,200. Now, accumulated depreciation is the running total of all our depreciation expense to date. We've only had $5,200 of depreciation so far, so it's $5,200. And then our book value is our beginning book value minus our last period book value minus the annual expense this year, or the beginning book value, the original cost, less the accumulated depreciation. So in this case, I'm going to take $13,000 minus $5,200 to give me $7,800. Okay? So book value is always the original cost less the accumulated depreciation. So I take $13,000 minus $5,200, get my book value. Again, notice we didn't use the residual value. We're not going to use it until later years. So now for year 2, we're going to take that $7,800 and make it year 2's beginning balance, right? Because we ended 1 year, that's what we start the next year with. So we have $7,800 times the 40% rate gives us depreciation in year 2 of $3,120. Now, our accumulated depreciation will be last period's accumulated depreciation of $5,200 plus annual expenses of $3,120 to give us $8,320. And then to get our book value, we take $13,000 minus $8,320, and we get $4,680. Now, in year 3, we're going to do the same thing. We're going to take our beginning book value, which is last period's ending, so $4,680 from last period, times the 40% rate, gives us annual expense of $1,872. Okay, my accumulated depreciation will be last period's depreciation of $8,320 plus $1,872 gives us $10,192. So then my book value is going to be $13,000 minus the $10,192 to give us $2,808. Now when we're getting towards the end of the life, like halfway or more, what we need to do is at the end of the year when we look at our book value, the book value can never drop below our residual value. We're not using the residual value in any calculation here. So we need to, at the end of the year, say, okay, $2,800 is certainly more than my residual value of $1,000, so I'm good. So then we do our next year. So our next year, our beginning book value is $2,808, okay, times the 40%, gives us $1,123. Accumulated depreciation, I add that $1,123 to $10,192 to my prior accumulated depreciation. So I get $11,315. And then I take my $13,000 original cost less the $11,315, and I get $1,685. And again, I'm doing a mental check. Is my ending book value more than my residual value? And it is. Now, in the last year, when I look at this visually, I go, this is the last year of the life. I know right away, I don't have to do any calculation other than a simple subtraction. My residual value at the end of the life has, or my book value at the end of the life has to be the residual value. So I don't need to do any calculation here. At the end, I can go over to the book value column and write $1,000. I have to, my book value at the end of the life has to be my residual value. So if my book value is $1,000 and my beginning book value is $1,685, depreciation has to be $685. Okay? But if I did $1,685 times 40%, I will get a number higher than $685. I can't do that. So this last year, I have to adjust that because what I want to end up with at the end is I want to end up with a book value of the residual value. I want to end up with accumulated depreciation of the depreciable cost. So with declining balance, double declining balance method, what you have to do is every year before you finalize things, you have to look at what your ending book value will be. Make sure you're not going below the residual value. This one worked out nicely that the adjustment was in year 5. Sometimes it can happen in year 3 or year 4. So you just kind of have to watch. I don't think you're going to run into that on homework. I just wanted to say mathematically it's possible for it to happen early, depending on what your residual value is. Okay, so that last year you kind of need to plug it because your book value, your ending book value can never go below your salvage value, residual value. Mm-hmm. Okay, yeah, and it could be lower, like in this case. It doesn't come out to 685. I guess I was going the other way. It has to, you have to end up in the last year at the balance of the residual value. So however you have to plug that, you have to subtract to get it. Okay. Okay, depreciation for tax purposes. Now for tax purposes, I'm sorry, accelerated depreciation. Accelerated depreciation, an example is double declining balance method. It provides the fastest tax deduction because we're taking more in the early years. So if I take a bigger tax deduction, that means I'm going to have a lower tax payment. If I have a lower tax payment, I am going to be able to take that cash that I save up front and reinvest it in the business. So everything else being equal, I want the bigger tax deductions in the early years. All 3 depreciation methods will give us the same total depreciation over the entire life of the asset. All 3 methods, you add it up, it's all going to be exactly the same. The difference is the timing. From a tax standpoint, you want to use an accelerated depreciation method because you can claim a deduction up front. You get a bigger deduction in year 1 and 2, which means you have cash in your pocket, you can reinvest the cash and earn on it, rather than giving the cash to the IRS earlier. So it is perfectly legitimate to use one depreciation method for your annual report, for your general ledger, that kind of thing, and then perfectly okay to use a different method on your tax return. Remember, your tax return is not a financial statement. It's not a vehicle for communicating financial results. It is simply a way for you to fill out the form so that you can tell the government, here's how much money I owe you. That is the purpose of a tax return. So it is, according to law, you do your financial statements using generally accepted accounting principles, that's fine. You disclose the methods you're using. On your tax return, you follow the tax code. And if the tax code says you can use accelerated depreciation, most likely you're going to do it because you're going to get a faster deductions, which gives you more money to use. So it is kind of weird to think, well, I'm using one method here and another method here, but that's legislated by law, and you disclose both on your financial statements. On your financial statements, you say, for example, I'm using straight line depreciation for book purposes, and I'm using accelerated depreciation on my taxes. Totally legit, done every day. There's nothing illegal or unethical about it. You do want to minimize your taxes paid. Okay, so with that, we are going to do a couple questions. The first one coming out now. We'll do an app share too. Okay, the first question, the accumulated depreciation account is an income statement account. True or false? Accumulated depreciation account is an income statement account. True or false? Okay, we're going to close the question in about 5 seconds, so get your answer in, true or false. And that is false. The accumulated depreciation is a contra asset. It is on the balance sheet. So accumulated depreciation is a contra asset. It offsets the plant assets on the balance sheet. Okay, one more for now. Book value equals the cost of the asset less the total accumulated depreciation. True or false? Book value equals the cost of the asset less the total accumulated depreciation. True or false? We're going to close this one in about 5 seconds, so get your answer in. And that is true. The book value is the original cost less accumulated depreciation. Now we're going to do a homework problem. And just as an aside, I'm going to be this afternoon or tomorrow morning, somewhere in that range, there's a couple of homework problems that we're not doing in class that I'm going to record step by step how to do them. So watch for those, and those will appear on YouTube sometime between now and before tomorrow noonish. Okay, So we have a problem here, short exercise 7-4, and we're computing depreciation for all three methods. Now the nice thing about this problem is it's only asking for the first 2 years, so we don't have to do every year of the life. And it's asking, it says we have a used aircraft at a cost of $52,400,000. They have a useful life of 5 years, 7.3 million miles, and has a residual value of $6,400,000. It gives us estimated miles flown each year. So we're going to start with the depreciation for the first 2 years on the plane using the following methods. So we're going to do first year depreciation for all three methods. Then we're going to come back and do second year depreciation for all three methods. So straight line, first year depreciation. This is our easy one. Straight line is taking the cost less the residual value divided by the number of years. So our cost is $52,400,000. Our residual value is given as $6,400,000 divided by the 5-year life gives us depreciation each year of $9,200,000, assuming it's a full year, and it told us that we bought this at the beginning of the year, so we're good. If you want, this is the first year depreciation. Just as an aside, this is the same calculation for the second year. Straight line will be the same every full year. What we're going to do, so that's first year straight line. Take our depreciable cost divided by the number of years. Depreciable cost is the original cost minus the residual value. So let's move on to units of production. Okay, units of production. Units of production, we're taking that depreciable cost, the $52,400,000 original cost, less the residual value of $6,400,000. We're taking that and dividing by the number of miles of life. Now they told us up in the problem that they expect the plane to remain useful for 5 years or 7.3 million miles. So I'm going to add the zeros on there and make that 7,300,000 miles. So I get a depreciation estimate of $6.30 per mile. So for year one, under units of production, my depreciation is going to be that $6.30 per mile times 835,000 miles. They told us that's how many miles it would fly in year one. So we get $5,260,500 as our depreciation expense for year one under units of production. Now, year one for double declining balance method, that's next. Double declining balance method. To get our factor, we're always going to take 2 divided by the life. The life could be 4 years, 5 years, 10 years. In this case, it's 5 years, so we take 2 divided by 5, so we get 40%. So to get our double declining balance depreciation, we take the cost of $52,400,000 times 40%. We can do that in the first year. So we get depreciation for year one of $20,960,000. What we've done so far is we've calculated the first year depreciation under all three methods. The problem is asking for depreciation for the first 2 years, so now we're going to do the second year for each of those methods. So you'll use some of those numbers in the second year. So straight line, second year depreciation, exact same as first year because we had full year. Okay, so it's going to be the $9,200,000. Same calculation. As long as you have full years, that you didn't buy it partway through the year, you're good. Now units of production, we're going to use that $6.30 per mile that we calculated for the first part times the 1,650,000 miles they're going to fly in year 2, and we'll get 10,395,000 under units of production method for year 2. Okay, now For year 2, under double declining balance method, we have to take the book value. The book value is the original cost less the accumulated depreciation. So we're going to take the original cost of $52,400,000, subtract the depreciation to date, which in year 2 would be last year's depreciation, $20,960,000, and multiply that by that double declining balance factor of 40%, and we get $12,576,000. Now, we've done depreciation in year 1, we've done depreciation in year 2 for 2 methods. The last requirement for this, show the airplane's book value at the end of the first year under each depreciation method. So what we're going to do is we're going to set up a column for straight line, for units of production, and one for double declining balance. And off to the side we'll have original cost less accumulated depreciation equals book value. Book value, original cost less accumulated depreciation. That's our book value. So now we're going to do this for straight line, for units of production, and for double declining balance. So I'm going to change the slide. It's the same thing off to the left. Cost less accumulated depreciation. So under straight line, we're going to have the original cost of $52,400,000. That's the same under all 3 methods. But the accumulated depreciation after year 1, it's asking for the book value after year 1. So just be careful. In the first part it asks for 2 years of depreciation. Here it's saying what's your book value after 1 year. So cost less accumulated depreciation of $9,200,000 under straight line gives us a book value of $43,200,000. We do the same thing with units of production, substituting the depreciation for year 1 for units of production. And then we do the same thing with double declining balance method using its depreciation. So we've come to the end of this homework problem. Now we have some more things to talk about that impact other homework problems. This problem was nice because we purchased the aircraft at the beginning of the year, so we had full year depreciation. And that's nice when we have something at the beginning of the year, but more likely we've got some partial years to deal with. So now we're going to talk about what to do when you have a partial year. So exercise 7.4, you're good, it's full years, but at least one other when you have a partial year. Okay, so let's go through an example of what we have to do when we have partial years. It's not bad, the adjustment's not bad, but you have to make it. Assume UPS purchases a building on April 1st for $500,000. So 3 months of the year have gone by. They own the building for 9 months of the year, April through December. The building's estimated life is 20 years, estimated residual value $80,000. So all those facts are given to us. And their accounting year ends on December 31st. So we need to compute the depreciation for the first year ending December 31st. So to figure out our first thing we do is figure out a full year depreciation. So $500,000 is the original cost less the residual value of $80,000 divided by 20-year life is going to give us $21,000 as our amount of depreciation per year under straight line method. Okay, so that's what we've already done. We've done that. That is the depreciation for a full year. So that's what they'll use in years 2, 3, 4, etc. They'll use the $21,000 per year. But this first year, they didn't own the building for a full year. They only bought it April 1st. So they only owned it for 9 months. So we have to take that $21,000 and multiply it by 9 divided by 12, 9/12 of the year. So what you'll see here is 21,000 times the number of months they owned it divided by 12 months in a year. So they'll actually that first year only take 15,750. You need to make partial year adjustments for the straight line method and for the double declining balance method. You do not need to make this adjustment for units of production. The reason is units of production is telling you how many miles they drove in that year. You can only drive the miles if you own the vehicle, if it's a truck, so you don't have to adjust for anything. So units of production never needs to be adjusted for a partial year. But straight line and double declining balance needs to be adjusted if we purchase it partway through the year. And we do this based on full months, not days. Okay, so that's partial years. Our next concept is changing the useful life of a depreciable asset. And again, we're not going to do this. You can go through calculations. If you're an accounting major, you're going to get lots of practice doing this. Changing the useful life of a depreciable asset. When we first buy something, let's say we buy a delivery van, and we say we're going to use this for 5 years. So that's fine. But after year 4, it becomes apparent that it's only going to last 4 years. Well, or maybe it's going to last 8 years, let's say. So we can change our useful life. As life happens, things change, our estimates are off. At the point where we decide that our estimate's off, that our estimate should be changed, we change it from that point forward. We don't go back and redo everything we did. So we change it going forward. This is actually called a change in estimate, but you do not need to be able to do it. Just know that we can change those estimates, but they affect everything going forward. We don't go back to readjust. Okay, and then fully depreciated assets. So let's say FedEx has fully depreciated equipment with 0 residual value. So let's say this is a delivery truck, and they bought it for $60,000. It had 0 residual value. They said, we're going to use this until it's just not worth anything. So they've used it up over the years. They've used it. It's at the end of its life. They have a original cost of $60,000. They have accumulated depreciation of $60,000. So it has 0 book value. They might use that asset for several more years. That's absolutely fine. They do not record any more depreciation. Once you're down to the residual value, there's no more depreciation to be taken. That doesn't mean you can't keep using it, but there's no more depreciation once you've depreciated it down to book value. Now, when FedEx gets rid of the delivery truck, they will take it out of equipment and accumulated depreciation. So it finally will come off both sides. It has no income statement effect. If we have, by the way, if we have a fully depreciated delivery truck and FedEx sells it to someone for $5,000, then FedEx has a gain on sale. But again, this way out of the scope of our course. If you're an accounting major, you get into that later on. But that's what happens. So we know these are estimates. Things are different. Residual values are different in real life, but we go forward with them. Okay, now we're going to do another question. No, I'll leave it on here. Well, yeah, do it. Yeah. Okay, the question is the three depreciation methods allocate different amounts of depreciation to each period, but all result in the same total amount of depreciation over the life of the asset. True or false? Okay, so our 3 depreciation methods allocate different amounts to each period, but all result in the same total amount of depreciation over the entire life of the asset. True or false? About 10 more seconds to get your answer in. 10 seconds. Okay, if you haven't answered yet, you have a few seconds left. Close it. Okay, that was absolutely true. We have all 3 methods do different amounts each year, but the total over the life of the asset is the amount of depreciable cost. So it's the same under all 3 methods over the entire life. Okay, we have another one. At the end of its useful life, the book value of an asset must be 0. Is that true or false? At the end of its useful life, the book value of an asset must be 0. True or false? Okay, 5 seconds. Last chance. Okay, the book value, this is false, and the reason it's false is at the end of its life, the book value of an asset has to be equal to its residual value. Its residual value might be 0 or it might be something else. So at the end of life, your book value has to be equal to the residual value. Okay, next up we have a calculation one. This looks harder than it is, so we're going to put up this next one. On January 2nd, 2012, Lummi Corporation acquired equipment for $45,000. The estimated life of the equipment is 4 years. Estimated residual value is $5,000. What's the amount of depreciation expense for 2012 if the company uses double declining balance method? On this one, if you're struggling with how to do it, with the double declining balance method, the first thing you have to do is get the double declining balance method factor, which is going to be 2 divided by 4. So we have 2 is always divided by the life, which is 4 years, 50%. Okay, so our factor is 50%. So you take the, since this is the first year, you take the original cost of $45,000 times 50% factor, gives you $22,500. You have no more than 5 seconds to enter your answer if you haven't already. Don't change your answer. You don't want to get caught up and not have an answer. But if you haven't answered, it's your last chance. We're giving you the answer. Okay. And of course the answer is that 22,500. Okay, that's all I have for today. I'll put those other videos up sometime between now and tomorrow noon. Have a nice weekend. Have fun at homecoming, and I will see you Monday. If you could